This is the Bloomberg Surveillance Podcast. I'm Lisa Abramowicz, along with Tom Keene and Jon Ferro. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. What gives? Let's ask that question to Michael Gapen, head of U.S. economics at Bank of America Securities. Michael, what is your reaction given the fact that markets seem to be a little put off by consistently disinflationary data?
I think the markets had, well, first of all, good morning, Lisa and Katie. Thanks for having me on. I think markets had priced this in already with the CPI data in hand and the PPI data in hand. We can make a pretty good projection of where PCE should come in. And we did expect the headline to be down a tenth and the core to only be up a tenth. So this number really wasn't a surprise to us. And if you do the implied CPI forecast from market prices, they're looking for pretty soft inflation over the next 3 to 6 months. So I think the market had largely priced in this number. As we all know, they're looking for about twice as many cuts this year as the Fed has planned. So I think this was a status quo number for markets.
That might be status quo. The durable goods orders, as Katie pointed out, not so much. It came in significantly higher than expected. And I wonder if on the margins there's some anxiety that it seems sort of incompatible that we could get ongoing better than expected growth while still seeing that disinflation that everyone's been hoping for.
Yeah, there's certainly a limit to that, right? So far the narrative is that the economy can cool, growth can remain modest or moderate, but away from recession, and we can experience both moderate growth and disinflation at the same time. That's our view. I think that's the Fed's view for sure, and why they've shifted to, say, a more balanced reaction function between bringing inflation down and wanting to support a soft landing. But you're right, there's a limit to that. There is a risk to shifting to a dovish stance now and coming out of the December meeting and tilting the outlook towards rate cuts, because markets have reacted quite quickly and financial conditions have eased. So the risk is that maybe you gin things up too much and you don't make as much progress as you want on the inflation front. So no free lunch in that regard. We think the Fed's in a good spot. We do think rate cuts are coming, but you make a good point. Too much easing in financial conditions could ultimately mean inflation is stickier to come down or maybe even rises a little bit and kind of puts off some of these rate cuts that the market is expecting.
Well, let's talk about just the magnitude of the rate cuts that the market is expecting. Of course, 150 basis points priced into next year, a big gulf between that and what we saw on the dot plot, just 75 basis points of cuts penciled in. When you take in totality what we learned today when it comes, of course, to PCE, to personal income, to spending, and of course, those durable goods orders, where does this land in terms of what the market is expecting? Do those 6 rate cuts look justified at this juncture?
I think the inflation data certainly support the idea that the Fed can start in March. So assuming the data flow trends in the way that it has, with a lot of evidence of disinflation and modest growth, but a cooling economy, we do think rate cuts can start in March a little earlier than the Fed thinks. We would say, curb your enthusiasm a bit for 150 or maybe more rate cuts over the course of the year, because we do think inflation will be a little more slower to come down. So we agree on the start earlier than later, but our view is you get about 100 basis points of cuts. So the market may need to reprice some of these as the data comes in.
So, okay, maybe that process back to target will be slower than expected. Compare that to what we heard from Jerome Powell last week. He said that he was reluctant to say that the last mile of this inflation fight will be more difficult. Is that your expectation, or does slower than expected sort of imply there's some pain ahead?
No, I would agree that at least again, the composition of the data flow that we've been seeing, I think, suggests we can enjoy modest growth and disinflation. And it does suggest that the last mile may not be overly difficult, right? So that does come from supply side effects, both on goods and on services, where reemployment has really helped increase services outputs. So we're getting a supply side effect there. As everyone knows, core goods have been falling for 6 months. So we'll see if things like shipping issues out of the Red Sea change that narrative. But otherwise, the last 3 to 6 months worth of data suggests maybe we can, it's more likely than not that we can get down to 2% consistent outcomes without needing to generate significant pain in labor markets, which would be a great outcome for the Fed, the average U.S. household and the average U.S. business. It would be a great outcome for the economy.
Well, I want to talk about that a little bit more because inflation has been enemy number one from the Fed's perspective for really the last couple years now. But now as we continue to get this march lower when it comes to some of these figures, does the Fed's focus shift here? Do they start paying more attention to economic growth, to the labor market, et cetera?
Yeah, I still think bringing inflation down is the number one goal, given where inflation's been, where it is, and the Fed's internal consistency about, hey, we really control inflation. We set that long-run inflation objective. We determine long-run inflation outcomes. So it's kind of, it's in their blood, so to speak, and in their DNA. So I still think that's, issue number one. But a very close issue number two, if not closer to balanced, is, hey, I think we can soft land this economy. We don't need to generate as much pain in labor markets as we thought we might have had to do 6 to 9 months ago. So we should keep an eye out for that. So yes, it does make an argument that one of the reasons why the market has so many cuts priced in is both of those cases, moving to a more balanced reaction function in an environment where the economy is cooling and inflation is slowing, that just increases the odds you're likely to get rate cuts. So I think the market is listening to that message.
Michael, what's the gap between just weakening that is good and weakening that is bad? And I ask this because I'm trying to still understand the language out of the CFO's office at Nike when they said that demand is cooling faster than they expected, revised downwards some of their expectations for sales, talked about cutting jobs. Is this something that is just an idiosyncratic business overlaid with a weakening economy in a good sense, or is this potentially something bad?
Yeah, I think I would put that narrative probably inside the rotation story away from goods purchases back to services. The goods side of the economy, the manufacturing sector, has been kind of on the edge, if not in a mild recession for some time now, at least in terms of production and inventory adjustment and so forth. So I think the goods side of the economy is reacting in part to that rotation story. What still looks pretty solid is activity and employment on the services side of the ledger, which is 2/3 or more of output. So I think to use your phrasing, the quote goods slowing and cooling is about the rotation story, the end of the COVID reopening impulse. Things should naturally slow down anyway. We need to provide an environment for the economy to do that while we bring inflation down without tamping on the brakes too hard. So you're right, there's a fine line between slowing that we think should happen as a result of a very unusual pandemic-driven cycle. And oops, we've got the monetary policy setting calibrated incorrectly. It's too tight. We have to back out of it more quickly.
Does anything about the services inflation concern you, given the fact that it still is running above what you would expect for 2% consistent inflation?
Yeah, certainly shelter and kind of the structural issues in the housing market without a lot of supply and inventory and available homes to contract for sale or purchase. So the shelter is moderating. It is coming down, but it's coming down more slowly than our models would have suggested. So we think that there's stickiness there. And even non-shelter services inflation has been more sticky. So this is where we would say, curb your enthusiasm. We have inflation for PCE coming down to around 2.5 year-on-year by the end of this year, where market implied pricing is closer to 2. So it's easy to see how a stickier inflation path could mean some of these rate cuts are not realized.
Michael Gapen of Bank of America Securities. Joining us now is someone who's gotten it right all year. Ed Yardeni, president of Yardeni Research, who called for the roaring 20s, is leaning into that now, talking about disinflation. We're seeing it now. What keeps you up at night, Ed, considering that so far you've gotten a lot of things very right?
Well, I've been sleeping pretty well, quite honestly. I guess I do worry about the Middle East, the geopolitical situation, the fog of war. You never know how things unfold once a war starts. And we have this fairly contained, localized war in Gaza. And that the risk is that it becomes a regional war and it affects the price of oil. But so far, the price of oil has been telling me that there's not going to be a regional war. going on here anytime soon.
So putting aside some of those tail risks, is the risk in your mind that people aren't bullish enough, considering that everyone's been upping their expectations for end of the year targets, but we're catching up to it really quick already, and it hasn't even been the end of the year?
Yeah, I think that's true. At the beginning of the year, I was talking about 4,600, and I wasn't bullish enough. We're already above that for the end of this year. And then I'm looking for 5,400 next year, and now there's more people talking about over 5,000. And then for 2025, I'm talking about 6,000. So I think I'm bullish enough. I don't think things can get much better than that. So that's kind of at the top end of the scale on optimism, I think. But I think in the near term here, we've got everybody seems to be too happy, at least in terms of the sentiment indicators. So that's at a near term basis. I don't lose any sleep over it, but I do watch it.
And with only, a week or so left until 2024, the fact that everyone is maybe too happy right now, is that why you haven't boosted your year-end target for this year? I believe that was at 4,600, and we're pretty firmly above that right now, Ed.
Yeah, well, I don't fine-tune my forecast that much because we are, as you said, we're only a week away, so what's the point of getting cute about it? Instead, I am talking about 5,400 by the end of next year and 6,000 after that. So that just puts me in the bullish camp. It's pretty clearly.
Yeah, if I, of course, had to put out these forecasts, I think I'd revise on December 30th every year and just nail it every single time. But I do want to talk a little bit about 2025 because 6,000 is a staggering number and 2025 feels very, very far away. What is the work that gets you there, and how do you project that with a certain degree of confidence?
Well, first, on a short-term basis, looks like there's still some what I call die-hard hardlanders who think that we're going to have a recession next year. I've been talking about a rolling recession for the past 2 years, and I think in the next 2 years we'll have rolling recoveries. Clearly, we're starting to see a rolling recovery in the housing market. I think we've bottomed in terms of retail merchandise. A lot of inventory is piled up. Now I think consumers are going to go back next year and buy some goods in addition to services. And I think commercial real estate will be in a rolling recession in this coming year. But then beyond that, I think there will be a recovery. So I think that's the way I look at the business cycle, is sort of spread out. Most importantly, I think we've got a labor shortage, significant chronic labor shortage. And I think companies will use technology to increase productivity dramatically. Right now, we're averaging about 1.8% over the past 5 years. I think that by the end of the decade, we'll be looking at 3.5% to 4.5%, which sounds far-fetched, if not delusional, I admit. But that's the way productivity boom cycles have gone in the past. And this one should do the same.
Does it worry you at all? And I realize that anecdotes can't tell entire stories, and you can't extrapolate out an entire research paper from one particular example. But let's take a look at Nike. They came out and they said that they're going to be cutting workers. They're going to be having cost cuts. And it is because, yes, they are working down their inventory, but because of weakness, and weakness that they expect to continue going forward. Does that kind of contradict some of your optimism about the recovery in the retail space?
Yeah. Well, that's a good point, and that's why I think a lot of forecasters missed the past couple of years and had this attitude that or view that the only way inflation could come down in the United States is if we have a recession. You mentioned the phrase immaculate disinflation, and I think that's what we've had. We've had inflation come down without a recession, and the reason for that is because the Chinese and the Europeans have done us a great favor. They've had the recession. So on a global basis, particularly China has been exporting deflation. Their PPI is down on a year-over-year basis. Even their CPI is down a little bit on a year-over-year basis. So I think the United States is going to benefit from the recession, the property depression in China for a long time in terms of having a low inflation. And I think Europe starts to recover from its shallow recession next year, which will help us on the export side.
And let's bring this conversation to the bond market because the reversal that we've seen there has been stunning. And of course, you've done a lot of great work on deficits, what that means for bonds and the demand for bonds. And it felt like for a while, maybe the bond vigilantes were reappearing. Why did deficit concerns seem to fall off the radar?
Yeah, I've had the point of view for many years that I'll care about the deficit when the bond market cares about the deficit. In the past, supply really hasn't been much of a problem because you get the biggest supply in recessions when the Fed was cutting interest rates. We had this brief period where the bond vigilantes saddled up and started to move on concerns of fiscal excesses. And that period didn't last very long. Basically, from August to October, we saw this monstrous increase in the 10-year bond yield from basically 4.25% to 5%. And here we are back below 4%. I think, there's an expression, don't fight the Fed. Maybe we should also say don't fight Janet Yellen now that she's at Treasury, because she very cleverly cut back on the supply of long-term bonds and notes and issued a lot of bills. And the bond vigilante said, oh, if that's the way you're going to play the game, we can live with that. Meanwhile, I think the big story has been how inflation's come down. I mean, it's been only the past couple of months that the consensus really has become that we can't have immaculate disinflation. Even Fed Chair Powell in his press conference seemed to indicate that, you know what, we may actually get it.
And everybody let out a collective cheer, and you still hear that cheer today. Ed Yardeni of Yardeni Research. Kim Wallace, head of Washington policy research at 22V Research, joining us here in studio for the holiday party, for the holiday spirit, for New York City. Thank you so much for being with us. We really appreciate it.
Good morning. Happy to be here.
Good morning. I know that you put out an outlook for what to expect in 2024, and I want to start in industrial policy, hinging off the latest news of U.S. Steel and some of the administration pushback to a Japanese conglomerate purchasing the largest steelmaker in the country.
Well, there's a lot of analysis that will go into the ultimate reaction from the administration. Obviously, the Committee on Foreign Investment in the U.S. will investigate the proposed merger. But when you break it down, the promises made by Nippon probably upset a few people on the political side, but don't, in my view at least, imply disruption to the production of steel in the U.S. The deal proposes to combine globally number 4 and number 27. So the first question for the competition policy reviewers is it a global market you're defining when you review the deal or the national market? My sense is it'll be a global market. And if that's the case, we look at Japan as a strategic partner. It's difficult to imagine that if Japan can't close a deal like this, that anyone can close a deal like this.
Do you think the Biden administration has been consistent with industrial policy? On one hand, talking about America first in some ways and talking about unionization, but not necessarily celebrating the fact that the United States is pumping a record amount of oil, which has really offset a lot of the prices and kept gasoline low.
I think they've been as consistent as you can be as a policymaker in this environment. A couple of points there. First, we have started from a very low point in industrial production and manufacturing. We gave away that base in the 90s and the first part of this century. Reclaiming it is going to take a long time. The report that the National Economic Council and the National Security Council put out in June of 2021 quantified how far back the U.S. is. The president then sought to make up a gap there. Congress joined them. This has been a bipartisan effort, particularly in infrastructure. So we are way behind the ball when it comes to, in the U.S., when it comes to infrastructure, when it comes to chips, semiconductors. We have a long way to go. Deals like this have to be reviewed from all of those perspectives we talked about, but ultimately, what's best for the U.S. in terms of short-term supplies and then longer-term building out of the industrial base. That's part of the president's proposal in the emergency supplemental. Almost $60 billion for a defense industrial base, $3 billion of that to build more submarines.
And you bring up chips, and that's where I want to go, because you think about the U.S.-China relationship, obviously still a lot of tensions there, a lot of that playing out in the semiconductor arena. But when you look over the totality of 2023, how has the U.S.-China relationship evolved?
It has stabilized, and the optics are better against a backdrop of severe competition. Competition across a lot of platforms, and that's not going to change. We see that almost daily. We saw it this week in critical minerals. And so when China decides that it's not going to allow the export of processing technology for critical minerals, that's a shot across the bow. It again points to a deficiency in the U.S. industrial base and something that it's hard to make this political if you look at it from an economic standpoint. Of course, people will make it political, but making up for the deficiency will require decades, not just years.
Well, in the context of critical minerals and, of course, the news that we saw this week, both on that front and also that U.S. Steel Nippon deal, you talked about Japan as a strategic ally here. And when you think about the arena of critical minerals, and, of course, the competition going on there, how important does that make Japan and potentially other partners?
It's that last part, Katie, potentially other partners. Japan is critically important. There is no Indo-Pacific strategy, which is important to this administration, without Japan. And that goes back to my saying, if Japan can't close deals, then no one can. But it's the other players. What we saw at the beginning of the APEC week that didn't get a lot of attention was a national security partnership signed between Indonesia and the U.S. U.S. sends defense technology, defense know-how. Indonesia promises to send critical minerals eventually. It's part of a very sophisticated program. Sophistication is necessary given how far back the U.S. is, in my view.
Taking a step back, you've gotten plenty of accolades for your research and for your view forward, particularly when it comes to politics, which recently has been a black box of absolutely impenetrable predictions. But I'm wondering next year what you see as some of the bigger market-related risks stemming from Washington, D.C. at a time where there's a lot on the table, not just industrial policy.
I think there are big four. The first quarter will be consumed by fiscal policy. What does Washington do around funding for FY24, and what does it do about the supplemental requests around wars? I think that morphs into first, second quarter. What's the result of the Fed's business over the last 2 years? How does that play out in the economy? Normalization at this part of the cycle means tightening. Normalization soon will mean the other side. That leads into, in my view at least, concerns about liquidity, both official liquidity, private liquidity. It's the topic very few people want to address in public, but something that pops up on a regular basis as a concern among traders all the time, both official and private liquidity. That morphs into the back end of the year and the elections and what's happening in terms of the outcome of the elections, what that implies for the country going forward and for policy in 2025.
And just in terms of the market risk there, meaning that as liquidity tightens, people will be more focused on that and the potential deficit and the potential inability of the U.S. to spend and all of those issues.
Well, that and the issues around the Federal Home Loan Banks. The administration is constrained the advances that they can make to member institutions. There's discussion about paying less for reserves at the Fed and forcing that money out into the economy or somewhere else. There are, and as QT goes on, we have a lot of tightening of liquidity in the system to follow.
Kim Wallace, thank you so much for being with us. Wonderful to see you in person. Kim Wallace of 22V Research, thank you. Joining us now, Deborah Cunningham, Global Liquidity Market CIO at Federated Hermes. Not on that at all. Deborah, thank you so much for being with us. I want to start with this idea that people have been talking a lot about cash on the sidelines. And we've talked about this before and how cash on the sidelines are going to start flooding into risk assets. Have you seen any evidence of that over the past couple of weeks?
Not really, Lisa. It's not something, generally speaking, people at the end of the year are trying to, kind of allocate and close out their books in a normal fashion. And there may be some surprises, either cash inflows or cash outflows, things close, things don't close that we're supposed to. But ultimately, it's not a great time in a normal situation for, what I'd call reallocation. That happens more at the beginning of the year. So we have not been experiencing or seeing that type of market shift at this point and cash flow out.
Well, I do want to get to what happens at the start of next year and in 2024, but I know I just said that AI and Ozempic have been really the stock market stories of this year, but I want to add a third thing, which has been the rush into money market funds. Of course, one of the big stories in markets this year, about $6 trillion sitting in money market funds right now. Where is that coming from? Is that investors saying, look at these high yields, I'm going to go there? Or is that people moving away, taking money out of their bank deposits, for example, and shifting into money market funds?
I think the bulk of it is coming from the deposit market. It's coming in as a retail trade, so it's a pretty steady trade. And if you look at what shifted out of retail deposits during the year, it's been about 1.3 trillion, and about $1 trillion has gone into money market funds. So it's hard to follow dollar for dollar exactly where cash goes. But from all we can tell, I'd say at least 80% of that is coming from the retail deposit market, where rates from a banking perspective just didn't follow, short-term rates in the market upwards with the Fed. Now, there has been in the last quarter, just really since we flipped into the fourth quarter, October and November, a little bit more of a cash flow from an institutional type of customer. And I think that has to do with, the flattening to some degree inverted yield curve, where the shorter end of the curve is no longer as attractive necessarily as what a product that has some weighted average maturity like a money market fund does. So we're starting to see some of that trade. I would expect to see more of that trade, though, in 2024.
So just to meditate on that point a little bit longer, that potentially 80% of what we've seen come into money market funds has been coming from deposits. How sticky is that money? Because it feels like one of the assumptions is that what we're seeing in money market funds that belongs to the equity market, or that belongs to risk assets, and it's going to return there. But if that's coming from bank deposits, that logic doesn't quite make sense.
That's exactly right. And certainly there are some risk assets that are in there as a hiding place, a short-term home until they feel like, their entry point back into their risk asset class is more palatable for them. But that's certainly not the bulk of what we've been seeing. Now, maybe that, will pick up again in 2024, but it's not been what we've seen mostly in 2023. It's come through the deposit market, through the retail trade, with the likelihood of that being very sticky. And I think the other thing that makes that a stickier trade than it has been even over the course of the last 15 years is we, as well as the market, and I don't think anybody out there expects the Fed to normalize at zero, where they have been, 12 out of the last 15 years. The expectation is the normalization is back to, 3.5, maybe 4%, depending upon where inflation plays out. And so that, again, keeps that retail trade generally in the market rather than back in deposits.
So do you just sort of reject, Deborah, this idea of cash on the sidelines flooding into markets once the Federal Reserve has cut rates 1, 2, 3, or even more times next year?
No, I don't reject it at all. I just don't think it's all coming out of money market funds. I think cash continues to come out of deposit products, and I think some goes into the direct markets through that, from that mode. And I do believe there will be some that comes out of money market funds, but I certainly don't think it's it's the vast majority of what will, let's say, fuel the markets, the risk asset markets in 2024.
Just real quick here, Deborah, are you seeing money go out of short term and go into longer term? Is that a theme?
It started, we run micro short and ultra short funds that are really just, a modest step out the yield curve in the 1 to 2.5 year sector. And we're starting to see positive cash flow in those products, but it's trickling. It's certainly not any kind of a flood.
Deborah Cunningham, thank you so much for being with us. I really want to get a sense of where we are heading into this, what kinds of disruptions we can expect, how people are paying for their travel, whether they are traveling. Brian Kelly, founder of The Points Guy, who did advise that I get rid of my points and spend them. Thank you for that. I'm trying to work them down. What do you expect in terms of this particular holiday season? Are we going to see another Southwest episode? Are things looking like they're pretty orderly? Are people going to have a not really deeply uncomfortable experience?
Well, I'm an eternal optimist, and things are looking really good, right? So the Thanksgiving holiday in November, we saw the most amount of air travelers ever, 2.9 million go through the TSA, and things were pretty smooth. And the biggest factor that I see would be weather. And right now, there's no major weather patterns that I see that could upend our air travel system. So I am forecasting, hopefully, smooth sailing for the next 10 days. We had 2.5 million people through the TSA yesterday, relatively low delays and cancellations. So fingers crossed, but I think this is going to be a good holiday travel season and certainly much better than last year.
Especially given some of those delays. International, though, does face some potential headwinds, in particular some of the strikes that we've been hearing about in the United Kingdom, elsewhere in Europe. Is that on your radar at all, or is that basically just sort of hand-wringing as people have to find something to worry about if they're not eternal optimists like yourself?
Yeah, no, anytime you travel to Europe, you have to worry about, strikes. They can happen any day. It's much different here than the U.S. But, in Spain, there will be strikes with Iberia's ground staff around the New Year holiday. Yesterday, we saw the Eurostar have a surprise strike that displaced a lot of people. They're actually not even selling trains today between Paris and London. But overall, there might be some German train strikers here or there, but hopefully no widespread strikes that we're aware of.
And so how should travelers think about that? Say that they do have a holiday European vacation booked. I mean, should they be thinking about insurance here, or how to best handle that?
Yeah, so what most people don't realize is when you use your premium travel credit card, as I'm assuming many people watching this program do, whether that's Amex Platinum, Chase Sapphire, Capital One Venture, those cards come with built-in perks. And this is what people don't realize. I was traveling to Puerto Rico in May, and my flight was delayed like 10 hours by United for a mechanical reason. United gave me a $100 e-gift card and told me to go away. But American Express refunded $500 for me to get a hotel, to get Ubers, to go out to dinner in Old San Juan. So always go to your credit card company for compensation. And when traveling to Europe, there's a rule called EU 261 compensation. And if you're traveling to or from Europe and there's a flight delay for pretty much any reason, they are mandated by the government to give you compensation. Yes, go to the airline, but generally the airlines are pretty cheap when it comes to compensation. Your credit card is where it's at. The only time I really recommend travel insurance is if you're going on that mega trip on a big expensive cruise line, safari, you're bringing, people who could get sick abroad where you might need that evacuation coverage. But in general, your credit cards protect you a lot more than you realize.
Yeah, so maybe you actually should read the fine print there. But what are you actually seeing in terms of where people are going when it comes to this holiday season? Are they going abroad, or is much of the travel that you're seeing booked and happening right now within the country?
Yeah, I mean, most of the travel growth we're seeing is international. It's funny, I was looking up, where are the deals for, I was just searching from New York, and the best travel deals were Miami, Orlando. And a year or 2 years ago, we all knew Miami flights were like $2,000 each, crazy rates. So we've seen some of that demand from domestic travel now. We're seeing huge increases. United Airlines just started flying nonstop from San Francisco to Christchurch, New Zealand. They're betting big on the Pacific region, new flights to Tahiti. And so I think there are a lot of travelers who now feel comfortable traveling internationally, doing that big trip. Japan, I'm going there in February. We're seeing huge increases in that type of travel. And also when it comes to lodging, we're seeing a huge increase. Hotels.com saw 125% increase in authentic lodging. So whether that's a ryokan in Japan or staying at a riad in Morocco, I think travelers are sick of paying for overpriced cookie cutter hotels and are willing to shell out for those luxury experiences.
Are they looking for discounts, or is this still very much the experience world that's just continuing? And is this basically a sea change that has legs, where experiences will keep seeing people pay up for some of these unique experiences, even if they don't buy a shirt and an outfit that's fancy to accompany it?
Yeah, people, funny enough, discounts are happening domestically. JetBlue just ran a $50 off fare sale, Southwest. So the domestic airfare market and those carriers are struggling, where the premium cruise lines that are just launching, there's tons of new, really exclusive ships. I just did expedition cruising is huge. I'm seeing more and more of my friends go to Antarctica. I just went on Swan Hellenic to Greenland, and that was an incredible experience. So yeah, people are shelling out for unique, bespoke experiences. That sector of the market cannot grow fast enough. Domestically, theme park travel is big. Disney still continues to see growth. And it's not just Disney. Dollywood just increased prices and opened up new parts of their park, Mattel. So people really want to take their families, not just to a beach vacation, but they want to go and experience the new Mattel theme park that just opened up in Arizona. They really want these unique experiences, and that's a trend I can foresee happening more and more.
And Brian, you are the points guy, so let's talk about some news that broke this week. It was first reported by Reuters, basically about the Department of Transportation in the early stages of looking into airline frequent flyer programs, really checking whether airlines have engaged in unfair or deceptive practices when it comes to some of those programs. What do you make of that?
Yeah, I mean, I think it's much needed. A lot of times there are changes that happen overnight, and, it can be said that the airlines are banks nowadays. The airlines are making more money selling their currencies of frequent flyer programs to banks. So I do think there needs to be a little bit more consumer heads up, right? If you're going to have this multi-billion-dollar loyalty program that essentially is a bank where, you're creating your own currency, you should give consumers notice when making negative changes. We saw this year Delta and American Express rolled out some pretty punitive changes to their credit cards, increasing fees, et cetera. And there was huge consumer backlash to mostly Delta on that one. And we saw them roll back some of their changes. Now, do I think the government needs to come in and regulate every aspect of loyalty programs? Probably not. But having some more consumer protections when those negative changes happens, I think are a good thing for everyone involved, because people are getting sick of just constantly changing and moving of the goalposts.
And waiting in line at the lounge. I mean, that might be part of the issue. Yeah, I mean, Brian Kelly, thank you so much for being with us. Brian Kelly of The Points Guy, thank you, as always. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Lisa Abramowicz, and this is Bloomberg.